Welcome to the accounting class. In this session we're going to talk about bad debts.
What do we mean when we talk of a bad debt? A credit sale is made to a customer who becomes a debtor. The credit sale will have stated the terms of payment. Let us say these were for net payment to be made within a period of 30 days commencing from the date of sale. After 30 days no payment has been received. Time passes, as that phrase goes, and no payment is received. At some point in time the business has to assess whether it is going to recover the money. If the assessment is that it is not likely to recover the money, then the amount owed is described as a bad debt. Sometimes this decision is easy. The customer has a business and the business goes into liquidation with no assets to pay creditors. This is a very obvious bad debt. Not all are that easy to identify. Usually the situation proceeds with a series of reminders being sent, the threat of legal action, and then consideration of whether the debtor is actually able to pay. Very often a sign that there is a problem may be that you send a cheque from the debtor to present to the bank. The cheque then gets returned to you because there are not sufficient funds in the debtor's account. Once an account is identified as uncollectible, what happens next? This is not quite as straightforward as you might think. There are actually two ways of looking at this. A good starting point is to realise that when we write off a bad debt, then it is an expense of running the business. So our first approach is called the direct write-off method. We have a debt of $350 and at some stage it is determined that this is an uncollectible account. What are the accounting entries that we should be looking at? Now, I said a bad debt was an expense of the business. So we open an account which we should call a bad debt expense, and we debit that account with $350. We're not going to be able to collect the $350 that was originally recorded as a debit to accounts receivable. So we need to reduce accounts receivable by this amount. In other words, we're going to make a credit of $350 to accounts receivable. The bad debt expense is recorded the actual loss. The loss of gross income is recorded in accounts receivable. Well, that was really simple, wasn't it? Or maybe it's not as simple as that. Can you see a problem with this method? I can. Do you remember bank reconciliations and timing differences? Well, timing can be just as important when writing off bad debts. A business is trying to expand and decides to offer a paint respray for vehicles to be carried out in the customer's home. At first, the business seems to be booming. There are lots of sales and the amounts in accounts receivable seems to be increasing dramatically. At the end of the year, both the balance sheet and the income statement look pretty healthy. Lots of sales and assets. It seems that this business is about to take off. Oops, then comes the catch. As the next year passes, more and more of the credit customers are not paying off the money they owe. More and more of them can't even be traced. By the end of the year, a very large sum has been written off for the uncollectible accounts. The figures for the year suddenly look awful. Massive expenses and a big reduction in assets. But is it really like this? What has gone wrong? The revenue has been recorded in the previous period. The bad debt expense is being recorded in the current period. Now, can you see that timing difference at play here? The better way of recording is to make allowances for uncollectible accounts in the period in which they occur. At the end of the period, we need to make an estimate of the amount we should allow for uncollectibles. What we're trying to do here is to follow the matching principle. We're trying to match revenues and expenditures to the same period. To do this, we shall attempt to reduce the receivables by an estimate for the uncollectibles, thus trying to match our revenue and expense. Let us do this with a short case study. Go Green sell wind turbines and their figures of $220,000 for accounts receivable at the end of the period, of which they estimate $4,500 will become uncollectibles. The journal entry will debit bad debt expense for the $4,500. It will credit an account called allowance for doubtful debt with the $4,500. This account is a little like a contra account to the receivables account. At the end of the period, the bad debt is reported as an operating expense. The allowance for doubtful debt will appear on the balance sheet. It will be set out to show that the receivables have been reduced by our figure for the estimate of uncollectibles. This makes the account a balance sheet account, so it's not going to get closed at the end of the year. Now, consider what happens when one of those estimated uncollectibles does become a write-off as a bad debt. The doubtful debt part has already been expensed. That was done in the period for which the estimation was made. Let's go back to our little case study. Robin Steele has already been classed as a doubtful debt, and it is now determined that the $200 owed will not be recovered. The amount has to be written off. An adjusting entry is required for the accounts. The journal here shows a debit to allowance for doubtful debts and a credit to accounts receivable. Now consider what happens when a doubtful debt is actually recovered. Go Green recover $500 that had been previously written off and recorded as uncollectible. So two entries are required. The first serves to reverse the write-off. The second serves to record the cash that's received. To reverse the first write-off as a doubtful debtor, our journal will have a debit to accounts receivable and a credit to the allowance for doubtful debtors. The entry restores the amount owed from debtors, increasing assets, and reduces the amount allowed for doubtful debtors. Whilst the second entry is going to be a debit to the cash account and a credit to accounts receivable, we have increased the asset of cash and reduced the amount owed by debtors. How we determine the amount for doubtful debtors can vary. Typically, it is expressed as a percentage of receivables. The percentage is determined by analysis of data from aging schedules. This ends our session on bad debts. Thank you for watching and for listening.